What opportunities can investors find in the gold mining sector? Well, there's no better source of information for that question than the major players themselves. Joining me today is the head of one of the largest gold miners in the world, Peter Marrone, Executive Chairman of Yamana Gold. Peter, it's good to see you again. Welcome back.
Hey, happy to be here. Thank you for the invitation.
Let's follow up on the conversation we had about 2 months ago, where you talked about how investors should throw caution to the wind and trust the gold mining sector. Well, gold mining stocks have done very well since your message. Gold itself has rallied, as you know. And my question to you is, a lot of this uptick in the valuations of gold miners has been due to the rally in gold bullion. Is there a risk, you think, of a divergence between the correlation of gold mining and the gold bullion in the foreseeable future?
Well, I believe that cycles are forever, so I don't know that the divergence will occur. To the extent that there is a divergence, my impression would be that there is a divergence that is in favor of the gold equities versus the gold price. Look, it's anecdotal. I appreciate that it is only our company, but our company, in the span of roughly 15 to 18 months, our share price has improved by just over 170%, more or less, whereas gold price would have improved probably 35 to 40%. I think that this is the time to be invested in equities more than the time to be invested in the metal itself. Admittedly, there's more operational issue that one needs to be sensitive to when investing in equities. But my view is the torque is really with the equities now rather than with the metal itself. Investing in the equities does give you more torque. And finally, David, I would say that the best way to look at the equities is, can we provide some recompense for the fact that as a company producing the metal, we do have operations that we need to be sensitive to. And of course, that means that there's always the possibility of risk. Well, we pay dividends. That makes a distinction between us and the metal. And it's a significant distinction. So one way to look at dividends is it a fair recompense for some of the risk while also providing all of that torque?
Speaking of dividends, you've just announced that you are increasing your dividend payout by 12%. And I'm wondering why you think this would be a great time to pay out dividends and reward your investors with this kind of cash flow.
Well, what we've done, interestingly, and it's a really good question, what we've done is we've said, let's step into this, but do it in a prudent, cautious perhaps, but certainly sustainable way. So we've increased the dividend a full 250%, roughly within the last year to 15 months. But we've done something in addition to that. We've said we're going to treat the dividend along with the normal ways to look at it from a yield point of view, to share price, to cash flows. We're also looking at it from the lens of what does it mean on a per ounce basis. Heck, everything else in our industry is done on a per ounce basis. How much can we afford to pay to our investors on a per ounce basis and still be a profitable business, still manage our replenishment of what we deplete every year and the opportunity for new mines and new expansions. So we've, first of all, decided to look at it from that lens. We've said between $50 and $100 per ounce initially. We're at about 70. I think there's room for upside. The second part is interesting because we're also sensitive to the fact that we are price takers instead of price makers with the metal. And so since we don't know where gold price will be, I certainly have a personal view that we're into a sustainably higher gold price and likely gold price will go higher. One can't build a business model on the back of that. We've also said that to at least approximate sustainability, we've created something called the Dividend Reserve Fund. The idea being that for at least a 3-year period, God forbid, gold price should decline and decline significantly, we can still afford to pay the dividend to our shareholders at the rate that it is set. So when we increase the dividend, we also want more of those cash reserves on our balance sheet that allows us to pay that dividend at the higher rate for that 3-year period.
Yamana Gold is not the first and only company in the sector to be raising dividends in the last 12 to 18 months. Do you think the industry as a whole is trying to compete for attention among some fixed income investing communities?
I can't speak to the broader market. I don't know whether or not that's the reason for competition. I would say that for us, and this may be true for the rest of the industry as well, dividends demonstrate a financial discipline. And I think it's important to show that financial discipline. Can you meet your business objectives and still have money, perhaps significant amounts of money left over? The second part to it is what I'd said earlier, which is, and this is my thesis, but I think there is some truth to it. The dividend should represent a distinction between investing in a precious metals company and for investing in the precious metal. So if you're investing in a precious metals company, we should be able to pay something that makes it distinguished from investing in the precious metal itself. There is no operational risk in investing in the precious metal. I described that there's torque to investing in the equity, to investing in the precious metals producer, but there's also some operational risk, and we should be compensating for that operational risk. That is in part what the dividend should do.
Yamana is also in the advanced stages of listing on the London Stock Exchange. Can you tell me why the diversification into foreign markets?
Well, we're listed on Toronto and New York, and it's interesting. When we went from Toronto and then established our secondary listing on the New York Stock Exchange, volume and liquidity almost instantaneously went to that exchange. That isn't to say that the Toronto does not represent an excellent investment exchange for us. It doesn't mean that the Toronto Stock Exchange does not have liquidity. It does, but about 2/3 to 70% of our liquidity is on New York. We're looking at it and saying there's a huge pool of capital. It certainly appears this way to us, that is held by investors that either by choice or by desire would like to have a local listing. And so we're looking at it and saying we would like to take advantage of introducing ourselves to those investors. And we think that there's a hand-to-glove type fit between what we offer and what those investors are looking for. That's the reason for listing on this additional exchange, the London Stock Exchange. We still like where we're listed, but we think that this will provide an opportunity for further investor appetite and also further liquidity.
Are you noticing an increased appetite, like you said, from retail and institutional investors who beforehand were not primarily invested in gold? Is that why you're expanding to different exchanges to capture new markets of investors?
We should be going, we as a company, but I think as an industry, should be going wherever there is an opportunity for to be introduced to new investors. We think that our company, this may be true of the industry more generally, represents an excellent investment thesis. In some respects, a better investment thesis based on the cash flow that we generate, the free cash flow that we generate, the opportunity for more cash coming into our treasury, the opportunity for extension of mine life, the entire business model. We think that on the back of that, we represent an investment opportunity that is bar none, that is the top of class, and that is not just in the mining or extractive industries, but more generally. And given the valuations that we see in some of the other industries, we certainly think that the precious metals companies deserve valuations that are comparable to that.
Peter, we're living in a very interesting environment where valuations of gold companies are relatively high, but interest rates are also very low. In this environment, would you, if you had to raise capital, would you prefer to issue debt or equity?
I would prefer to do neither at the stage that this company is at. So we've gone through the cycle of becoming investment grade, raising debt. There's a challenge because, as I said earlier, we're not price makers, we're price takers. We don't know where the precious metals price will be. So maintaining debt on a balance sheet and then hoping that we can pay it down and the precious metals prices stay at certain levels has its own attendant risks, and we're not prepared to take those risks. Where we are now, David, and this is important for your viewers, is that we are not in need of any capital. We're fully funded. We have an excellent leverage of below 1 turn of our EBITDA, and that continues to improve. We've got large cash balances on our balance sheet, just about $325 million on the balance sheet, with no debt repayments that are due, certainly within the next couple of years, and modest ones at the end of that couple of years. And so we're looking at it and saying we're not inclined to raise equity. We're not inclined to raise debt. We will fully fund our business organically with what's inside the company and the cash flows that we generate. But may I make one more observation? I do not agree. I don't subscribe to the view that precious metals companies are trading at high valuations. I'd say that we're trading not consistent with where the gold price is. I don't think that the broader market has yet appreciated that gold price is trading above $1,900 per ounce. And at $1,900 per ounce, that represents excellent margins for us, perhaps for many of our peers. And that implies that we're going to be generating some very robust cash flows and free cash flows. And we've seen that in the first half of the year, a half of year that is normally weaker for us than the second half of the year. And despite that, we are generating strong and increasing cash flows and free cash flows. And if we apply a multiple to that, I think that the multiple at which we are trading, and perhaps the industry more broadly is trading, is still low by comparison to where it should be.
So you're saying seniors are trading at a discount to net asset value right now?
I'm saying that we can all see, I can certainly see a world where the multiple to cash flow will increase. The multiple to net asset value is in part a bit difficult to gauge because often companies have a view of their internal view of net asset value is different than what's in the public marketplace. Our obligation, we see it as an obligation, is to indicate and demonstrate to the marketplace that we've got more net asset value. So today we may be trading at a multiple of more than one to our net asset value as it's represented in the public marketplace. But in terms of our own internal numbers, that is discounted, and we need to show that we've got more net asset value. An excellent example of that is our underground at Canadian Malartic. This is more than a 10 million ounce deposit and growing. Within the next couple of years, we will determine a development plan. But as you're aware, David, there are a score of these operations in northern Canada. So it's not difficult to benchmark what's the shaft requirement, the size of the hoist, what's the development cost. And when one puts that into the mix, you can come to a very, very elegant view of the additional value that is at our Canadian Malartic mine. There are many investors and analysts out there that are valuing it only based on its open pit, which is the next 7 years. But that underground may be several decades. And within the next couple of years, we'll be demonstrating the value of that underground.
Let's talk about your announcements of sales earlier in the year, Equinox Gold shares and your royalty portfolio. Can you walk us through the rationale of these sales?
Yeah. So this is perhaps the culmination or near the culmination of a plan that we had initiated several years ago. We came to the conclusion that we should be rationalizing the portfolio of the company to the 5 producing mines that we have now and the expansion opportunities along with the other development opportunities in the company. That is a rough way of saying that we're looking to sell several of the assets that we had. And in some cases, we went to an outright sale. In some of the cases, we took a different approach, which is some of these assets require more maturity. We need to do more work on them. But let's not distract the core business with that. So we segregated some of those assets and we put them into a new company that was then, with that management, taken public. And then through a series of mergers, that's how we get to our investment in Equinox. The objective was ultimately to say we can monetize our investment in these assets, but let's give it time. Let's make sure that we mature these assets, or at least have a management, including successor managements through a series of mergers, that gets it to the right point. Earlier this year, we came to the conclusion that Equinox had gotten to that right point, certainly for us. Excellent business plan, a production platform that was at least a 500,000 ounces, and we came to the conclusion that we should be selling some of that investment. We still own shares in that company. We'll continue to see what the timing is for the further monetization of those shares. But we'll be disciplined and we will be prudent. Nomad Royalties is another example of that. And Nomad was royalties that we retained on certain sales. And what we did was, rather than sell the royalties outright, normally these sales occur at one-time net asset value, we sponsored and helped we promoted the creation of a new company. And that's Nomad Royalties. Now we're an investor of that company. We own 13% of that company. And to date, the thesis has proved to be correct. Rather than getting one-time net asset value on an outright sale for cash, the stock price has performed brilliantly, better than we anticipated in many respects. So the result of that is that we're holding in our equity more value than what we would have gotten just on a sale.
Peter, one of the questions that investors have had is whether or not, and not just for Yamana Gold, but for senior miners as a sector, is whether or not miners have faced cash flow challenges in light of COVID-19's cutting of production over the last quarter. You've obviously raised dividends, and so I'm assuming you don't see any challenges to your cash flow from operations in the future. Is that correct?
Well, this is a serious problem, David. This is an ailment that we should all hope will find proper remedies or vaccines or what have you very soon. But we were impacted in the first quarter and part of the second quarter by the suspension of operations at a couple of our operations, our Cerro Moro mine and our Canadian Malartic mine, as a result of government orders, while governments were rightly trying to figure out what to do about all of this. In many respects, the good news is that there's a better handle, certainly in the government of Quebec and where we are in the province of Santa Cruz in Argentina, so that there's been a resumption of mining, and mining is either as a result of law or de facto been determined to be an essential service, and it should continue with operations. So we've been ramping up those two operations through part of the second quarter, and we're now, at least with one of them, Canadian Malartic, now fully ramped up, and Cerro Moro now continues with its ramp up after that temporary suspension of operations. So we felt the impact of it already. That's reflected in our Q1 and Q2. It does look as if we've now got a reasonable handle on what we should be doing to ensure the health and safety of our workers and making sure that they're protected, along with local communities being protected. And we're working very closely with local communities, state, provincial, and national governments to ensure that we've got the right protocols in place. David, look, our obligation, first and foremost, is the health and safety of our workers and our local communities. But there's a way to be able to manage that effectively, while at the same time also managing our operations. Going forward, I don't see that there will be an impact to our operations. We've already felt that in Q1 and Q2.
When we talk about the expansion of your portfolio, how important is Greenfield exploration versus the acquisition of junior miners?
So it's again, a very, very good question. The best way to look at how we're managing ourselves, our business plan, our strategic plan, perhaps, is let's look at short-term, intermediate, and longer term. And in the short term of the next 3 years, and immediate, let's say 3 years to 5 to 7 years, and longer term, 5 to 7, all the way up to 10 years. We have a generative exploration program that we've just introduced. We've been working on it for a couple of years, but we introduced it as a separate program inside our exploration effort only within the last 9 months to 1 year. We've indicated that we're spending $53 million on that generative exploration program within the next 3 years, 14 million this year, 18 million the year after, and the balance in the third year of that 3-year program. 7 identified opportunities where we've already done drilling. There is mineralization. 2 of those opportunities, one in Canada, one in Brazil, where we already have an identified resource, at least in the inferred category, in some cases in the indicated category. Our objective in the next 3 years is to have at least one of those get to 1.5 million ounces. We think that we'll get there with at least one, and we will build a mine plan on top of that for the next generation of mines into that longer term that I mentioned of at least 150,000 ounces per year for an 8 to 10 year period. That's the purpose of that generative program.
I spoke to a fund manager recently who said to me that he believes senior miners should not be specializing in greenfield exploration because that's not their wheelhouse. How would you challenge that statement?
Well, I'd always be careful that someone isn't saying that because they're invested in junior companies or explorers and they're looking for senior companies to buy them. But I would say that there is some truth to that. Historically, some of the significant discoveries have come from more junior exploration plays, and the senior companies have then acquired them. But I think you can have the entire gamut of what a mining company should be doing within your own company as part of your management. And so, yes, you can be a very strong producer, a very strong in development, very strong in acquisitions, health and safety, but exploration is an important part of that. Our exploration effort has demonstrated with those 7 identified opportunities that we can make new discoveries. Our challenge now is to demonstrate that we can take at least one of those discoveries, maybe more, and take them to a resource and then a mine plan on top of that. But one of the things that we've done that I think you'd find interesting is that we've also said we're not going to rely only on exploration alone. Exploration is working hand in hand with our technical services team. So the technical services is on a real-time basis saying, if this is where exploration is going and what we think we're going to discover and how we're going to mature that discovery, then we're already looking at how we make that into a mine plan. And so rather than saying we've discovered X millions of ounces, but then it goes nowhere, we're looking at it and saying we're more inclined to discover the right number of ounces that delivers a mine plan.
Final question for you, Peter. As you know, indexation of mining companies, in particular ETFs, has become a very popular investment vehicle of late over the last few years. How would you convince an investor that it's still prudent to buy individual companies versus an index? What opportunities should they be looking out for?
Well, I'd say that the best way that I can answer that question, again, I'm a market participant only as an investor, and so I can speak only from that lens. But I'd say that as an investor, there is a prudence and a logic to investing in a portfolio of companies. And if an ETF provides the right mix of that portfolio, then that's a good way to invest in a sector. But a portfolio is also looking at the size and scale of a particular company without looking at the particular company. So it's going by market capitalization rather than by the specifics of the company. That means that you could be missing a whole host of opportunities without investing in a particular company. Or worse, you could be investing in an index that is loaded with something that has a large market capitalization but has risk. So I'd say that there is room for both. And we're now in an environment that, given where gold price is at, there is significant room for both. And certainly I think that while we are delighted by investors who invest in ETFs where we're a member or a participant in that ETF, we also think that they should be looking more closely at our company and seeing the value proposition, and that may be true of other companies as well.
Excellent. Peter, I want to thank you very much for coming on the show today and spending time to talk with me. I appreciate it.
Much appreciated. Thank you, and good to see you again.
Good to see you. Thank you for watching Kitco News. We'll have more for you at the Mines and Money Online Connect conference. Stay tuned.